Hello, today is Wednesday, January 13th, and thank you for joining me for another edition of the Market Commentator podcast. My name is Andy Willms, and I am the president and CEO of the Milwaukee Company. This week's podcast marks a new beginning for our podcast. We're going to a slightly different format where I will be having a weekly guest join me to talk about different topics that I think you, my listeners, might find of interest. Joining me today is Jim Picerno. Good morning, Jim.
Morning, Andy.
Jim is the Milwaukee Company's Director of Analytics and the editor of the Capital Spectator, a highly respected finance, investment, and economics blog. Jim is also the author of several books on investing and has been quoted by a number of news organizations, including the Wall Street Journal, Reuters, and so on and so on. Thank you for joining me, Jim.
Happy to be here.
Jim, I'd like to discuss with you today the supposed death of value investing. But before we get started, I want to remind my listeners that they should keep in mind that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast. I also want to remind you that the views expressed in today's podcast are those of Jim and myself, and not necessarily those of the Milwaukee Company. And with all that legal mumbo jumbo out of the way, I'm going to ask you, Jim, what is really value investing?
Well, it's a great topic because many benchmarks of value investing, as most investors probably know, have been performing quite poorly. So it's a great question. What is value investing? And at its core, it's really pretty simple. I mean, you can get very complicated with this stuff, and maybe we'll get into some of the weeds here, but at a very basic level, it's really all about quantifying the value of an asset, typically a stock or a bond, and using one or more factors to quantify that value, such as cash flow. And a value investor would buy the asset if the estimate of the value, if the price is below that estimate of the value, and avoid it otherwise. So in other words, if something's worth, you estimate it's worth $1 and it's trading in the market at 90 cents, that's a value buy. If it's trading at $1.10 or higher, let's say, you would avoid it. That's basically how value investing works at a very basic level.
So at that basic level, it would seem that really almost everyone's a value investor in a sense, because no sane person wants to overpay for stocks. They want, and I think that, the father of value investing may have been, Ben Graham, and I think that's the way he looked at it. I think he said, while the market's by and large efficient, right? Sometimes certain stocks might be selling for less than what they're worth. You want to buy those, and some stocks are selling more than what their fundamental information would suggest, and they're overpriced, and those are the ones you want to sell.
That's basically right, although I would tweak that to say that while nobody sets out to buy overvalued assets, there are investors who don't really prioritize that. So, and they're not really even concerned about valuation. They're more concerned with the notion that, well, this asset is going up in price, and even if it is overvalued, or even if it isn't, I think it's going to continue to go up, and so I'm going to buy it regardless of its valuation. But for a value investor, that's just anathema. Value investors have to have some basis for deciding that there's a discount to the market price.
That's an excellent point, Jim, because you're right. There is a school of thought that you want to look at other influences on the market, especially if you're a trader versus a long-time holder. I guess I should have qualified. I don't think any long-term investor, anybody buying a stock for the long term, is interested in overpaying it. But if you're a trader, you're not worried about value as much as you are about what's going to happen tomorrow, because you might very well be selling your stock tomorrow, and so you tend to be more focused on the direction of the stock and the thought that it will continue that direction maybe over the short term. Does that make sense?
No, that's correct. I mean, there's the so-called momentum traders who, through various means, are estimating where the price is going. Growth investors, to some extent, fall into that category, although that's a little bit warm and fuzzy. But in both cases, it's certainly distinguished from a true value investor.
I guess what we can say is that the price of a stock is kind of, based on fickle sentiment, greed and fear, but the intrinsic value depends on a company's earnings power. And, that in turn, derives from, the capital assets on its books, its factories, machines, offices, and so on, but also its intangible assets as well. So you mentioned on your opening comment that value investing has sort of struggled as of late. And do you have any idea of why that might be?
Well, that's the million-dollar question, right? I mean, everyone is in recent years become focused on values, relatively weak performance, and trying to come up with reasons as to why. And there's any number of schools of thought on this. You could spend a lot of time going through the reasoning, but one that really resonates with me as a possible reason is that the issue of value investing in recent years has become very quantitative, and that's because of the rise of computing power, and it's become much less expensive. So it's really easy to run value screens now, and everybody seems to be doing it, whether you're a hedge fund or traditional money management bottom-up stock picker. But this creates a problem because at the end of the day, it's not obvious that a stock that's trading at a low valuation metric is always a value stock. I mean, there's the problem of what's known as value traps, where a stock is trading at, say, a low price to earnings ratio or a price to cash flow ratio, and quantitatively it looks like a great bargain. But the problem is that a low valuation metric stock may not be a value stock because the prospects for the company, the underlying business model may not be favorable. They in fact they may be pretty ugly. So the ability to that skill set that's needed, ideally you need sort of a Warren Buffett or a John Templeton kind of skill set to separate the low valuation stocks that have poor prospects from the ones that have a good outlook, and that's not easily done with quantitative screening. So that may be a reason why a lot of these index-based value funds aren't really doing all that well.
I suppose it's kind of like, if the stock of a buggy whip manufacturer might look good as a value stock, but in reality, it would have been a terrible investment because buggy whips were become obsolete with the advent of the automobile.
Well, that's exactly right, and the father of value investing, Ben Graham, wrote about that exact problem. And if you read securities analysis and some of his other papers and books that he published back in the day, I mean, you get a really good sense that value investing requires a fair degree of qualitative analysis. And so, at least there's many investors who think that this whole issue that surrounds the issue of trying to figure out if a stock is threatened by the value trap or not is probably one reason why value hasn't done as well as it should.
I think that's a very good point. And but I also think there may be another component to it. And I think it's because there's been this shift from tangible to intangible capital, where you have from economies where factories and office buildings and machinery were key to the value of a company, to one where it's more about software and ideas and brands, clicks, general know-how, all those kinds of things. And those are a lot harder to assign a precise value to, than tangible capital. And so it's much harder to really know what the true value of a stock is, and therefore whether its market price is higher or lower than its intrinsic value.
No, that's a great point. And the rise of tech companies in recent decades really highlights this point. I mean, if you compare, take the original Standard Oil and its offspring, the Exxons and the Mobils, they took decades and decades to get to the point where they were huge, massive companies with hundreds of millions, billions of dollars in revenues and cash flow, and they employ hundreds of thousands of people. And then you compare that with today's tech titans, the Facebooks and the Googles of the world. I mean, we're talking companies that are, maybe 15 years old, give or take, and they've gone from zero to where they are now in very rapid fashion, and they employ very few people. But the key issue here is that, you take Google, for example. I mean, it doesn't really own anything per se. It obviously occupies office buildings and has a lot of computers. But at the end of the day, most of the, if not all of the value of its franchise is in its employees, and perhaps to a larger extent its brand and its management of digital assets, the search engine, etc. I mean, these are not tangible items, as you point out. There's no there, and so valuing this kind of properties is something new and unprecedented. And although Wall Street analysts and others have made great strides in this in recent years, it's by no means a open and shut case on how you should go about valuing a tech firm, an internet property. So it's a real challenge.
And Tesla is a great example of this, right? Because if we were to look back 2 or 3 years ago, when Tesla was trading for a small fraction of what it's trading now, you would look at it and you would say, well, it's hard to justify that based on its physical assets, right? But if you look at it today, it's trading at a much higher multiple, and yet now I think most people would agree its physical assets exceed the value that it had, 2-3 years ago. So stocks can become, or Amazon, maybe that's even a better example. Amazon has acquired a lot of physical capital assets to the point now where it's, becoming more of a value stock than it was ever expected to be a few years back.
Yeah, no, it's true, and there's many examples. I mean, Twitter comes to mind. I mean, it's hugely popular, it's influential, but how do you value it? I mean, almost everything it's doing is on your computer screen, and so exactly what are the assets and how you value them is a bit of a conundrum compared to back in the old days. I mean, you're going to analyze what General Motors is worth or IBM. You had physical assets, and so it was easier, plants and equipment and that kind of stuff. But a lot of these companies, they exist sort of in the ether. That doesn't mean they're not hugely valuable, but putting a price tag on what that value is quite challenging.
Do you think this means that there's been some, let me say this, back up and say, but there's been some rotation into value stocks lately, and partly that's been partly driven, I think, by the extremely high valuations for a lot of the so-called big tech names, the FANG stocks, about Facebook, Apple, Microsoft, so on and so forth. Those values have gotten, their prices have gotten so high that people have been rotating into the more traditional so-called value names. But as of late, do you think this marks the comeback of value investing to some? I mean, for a long time, value was considered a market premium. A factor that was a way to capture outsized market returns. So the so-called value factor. Do you see the value factor as having a future, or do you think its time has passed?
Well, I think that there's a gray area here. I mean, in some respects, I don't think the value factor will ever go out of style or die, because the ability to buy assets at a discount, assuming you can estimate it properly, and avoid the value trap. I mean, that's just an evergreen kind of investment strategy that'll always be useful. The problem, of course, is that you never know when the market's going to properly value a discounted security. It could be tomorrow, it could be in 10 years. So you have to be patient with, generally speaking. But beyond that, I mean, the rotation into value can make sense, but I think investors have to really be careful here, because value as a strategy comes in many, many different flavors. And as I mentioned earlier, some of these flavors may not be all that productive if they're heavily reliant on sort of a passive quantitative approach. It can work, but the devil's in the details. But there are some value funds and investors who really know the game quite well and do pretty good even under these sort of value drought conditions. And so you really have to do your homework when you're picking value funds.
Right.
I mean, there is a lower risk aspect of it, particularly these days. So it's a very intriguing area that's worthwhile to look into on a closer level.
I think that's a great point, Jim. And I also think it depends on an investor's personal investment objective, time horizon, and tolerance for risk. For a long-term investor who has a lower tolerance for risk, I think value stocks may still play a prominent role in their portfolio, albeit it should be a diversified portfolio. But I think it could remain a prominent role because, as you point out, value stocks have a lower degree of risk because you're ostensibly paying less for something than its intrinsic what its intrinsic worth is. You do have to be careful when you're investing in individual stocks. If you're buying individual value stocks, that you aren't buying a company that's simply, whose business model is permanently flawed, and therefore you don't expect there to be a sort of reversion to the mean. But if you're investing in a broad-based value index fund where they have, many names in the fund, then you're probably not as worried about one or two bad apples in the bunch, right? Because overall, the value index should, in a long-term horizon, perform well and be more stable than a growth-oriented type of index fund. But I stick to the basic premise that diversified portfolio is the best way to go, and to have exposure to both value and growth make the most sense for a lot of investors.
Agreed. Value and growth tend to have a relatively lower correlation. And so, from a diversification and asset allocation perspective, and combining the two has real tangible benefits. But again, the caveat here is because value, there's no one consensus way to define value. You really have to be careful in how you're defining it, whether you're picking stocks and bonds on your own, or you're choosing a mutual fund or ETF. There's just so many different ways to create a value strategy, and they're not all created equal. So
that's yeah, that's a good point, Jim. And I think that there's a role for both in a diversified portfolio, but you're absolutely right. One of the key things to keep in mind is how value is being defined, and whether you're investing in an individual stock or a value fund, or whether that be an actively managed fund or an index fund, you want to make sure you're comfortable with the way value is being defined by the fund manager. Well, I think that'll wrap it up for us today. Jim, is there anything else you'd like to bring up that we haven't yet covered with regard to value investing?
I would just say that it's important to keep an eye on some of the popular valuation index benchmarks to make sure if you're an investor looking at this area, you're familiar and comfortable with the context where the market has been, and as a possible sign of where it's going. I mean, value doesn't create itself in a vacuum, so it's important to monitor it.
Yep, and neither one of us are market timers per se. So but through tactical asset allocation strategies can help you decide how much you should be allocating to value and how much should be allocated to growth. Maybe in a future discussion, Jim, you would be kind enough to come back with us and talk a little bit about